Goeiedag en hartelijk welkom by Regout met Robinson op Litnet. Ons spesiale gas vandag is Dr. Leila Fourie. Sy is die groep bestuurshoof van die Johannesburgse aandelebeurs. Sy sit dag na dag met haar vingers op die pols van die land se ekonomie. Min is so goed toegerus om die JSE te bestuur soos sy. Leila glo die Suid-Afrikaanse beurs is daaraan beter toe as die landsekonomie en dat mense die situasie verder afrem deur negatiewe praatjies. Sy was al van tevore 'n direkteur van die JSE en het 'n senior bestuursposte gedien onder meer by Standard Bank, waar sy ook wye blootstelling gekry het in die VK, Hong Kong, Argentinië, Rusland en Brasilië. Voordat sy in Oktober verlede jaar in haar huidige pos aangestel is, was sy 3 jaar lank in Australië, onder meer as 'n senior bestuurder van die Staatsbondsbank, die grootste bank in die land. Leila het 'n doktorsgraad in ekonomiese en finansiële wetenskap. Vir ontspanning klim sy rots, seker die soort sport wat 'n mens dryf om altyd hoër hoogtes te probeer bereik, terwyl jy die vrees vir risiko trotseer. Met 'n van soos Fourie klink sy Afrikaans, maar soos eintlik Engels. So welkom Leila, and if you put your fingers on the pulse of the JSE, what does it tell you about the ebb and flow of funds and probably about the economy?
Thank you, Fourie, and thank you very much for having me this evening. So the economy has been through a very tumultuous time, for fear of stating the obvious. I think what is particularly interesting is that notwithstanding the basic economic problems that we're facing into, such as low growth, the fiscal cliff, the high unemployment and the SOE crisis, we have managed to come through the COVID crisis very well, and we've also weathered the downgrade of the country to sub-investment grade much better than many people thought. So if you look at how that translates into the stock exchange, the capital markets and stock exchange have fared a lot better than the real economy, and we've bounced back. We've got almost a V-shaped recovery rate. As quickly as we went down, so we've come up. And so right now the top 40 is in positive territory, almost 1%, 0.6% up, and the all share, so all of our stocks are just slightly down, almost 3%. That is driven by some key top performers that we've got on the exchange, such as Goldfields, which is up by 134% off the back of resources and the deteriorating rand price, together with Anglo Gold, which was also up 57%, and then also tech companies such as Naspers and Prosus, who are up 34% and 60% respectively. So we have seen a bounce back, and we have been fortunate in the country to have companies listed in the entities that are growth nodes in the current economic climate. And relative to the rest of the world, we are doing surprisingly well, especially on our all share and top 40 index.
And compared to emerging countries?
Yes, so look, if we compare ourselves across the world, South Africa's top 40 is up about 0.6%, and the all share is down almost 3%, as I said. Brazil is down 14%, and the FTSE 100 in the UK is down 21%. And that compares to NASDAQ, which is up about 28%, and Shanghai, which is up 10%. So you can see these vast differences between the countries. And I would suggest that perhaps some idiosyncratic factors relating to each country is driving some of that. Some of which, for example, in Brazil, is related to the fact that they have, I would say, the second highest number of COVID cases, and there are questions around the ability of the health system. And so that's reflecting in business confidence generally. London is obviously, London flows are obviously affected by Brexit, together with the mix of stocks that they have. And the US NASDAQ being up 28% is really a reflection of the interest in tech companies. So what we are seeing is that those countries that are very heavily invested in industrials, in the motor industry, in the hospitality industry, are worst affected. And those that are heavily invested in technology companies are bouncing back much quicker. And the reason for that is that not only is tech a growth node, but the connection between the real economy and these new tech and data companies is not as significant as those between the industrial companies. So on balance, the JSE is actually doing remarkably better than many of its equivalent counterparts in the emerging market environment.
So that explains why you think actually that the JSE is doing better than the economy in South Africa.
Yes, absolutely. It's there are a couple of reasons. Firstly, I think the JSE has always punched way above the weight of the real economy. We are 19th best in the world in GDP, in market cap terms, whereas we are 33rd in GDP terms. And the reason for that is that we have a number of very big multinational names. We have 109 dual listed companies of 342 listed entities. And those dual listed companies attract phenomenal foreign investment interest. We also have a number of rand hedges, and I think the combination of the high level of resources together with the high tech focus in companies like Naspers and Prosus really does help buoy the exchange. We are a concentrated exchange, and to the extent that one or two of those very large companies experience some form of dislocation, that would be concerning to and would have a significant impact. So that's our vulnerability, I suppose.
Soon after your appointment last year, in November, in fact, you went overseas as part of a team of the Minister of Finance, Tito Mboweni. And you obviously had the opportunity then to speak to investors, foreign investors. Now, in the meantime, COVID-19 happened, and that was a disaster, absolute disaster globally. Now, if you meet the same investors today, what are you going to tell them? Is it still so attractive to come here?
Well, in fact, I have been in contact. We are busy finalizing the plans for the same roadshow, which will be held virtually, and we hope to expand that roadshow to other geographies. And we're hoping to have a very senior delegation of public and private sector representatives. And what I've heard from anecdotally from some of the investors is that the rest of the world is underweight South Africa insofar as the emerging market flows go. So over the last year, China was introduced into some of the emerging market indices, the MSCI, for example, and Saudi Arabia, China was rebalanced and Saudi Arabia was introduced, and that crowded out funds that came into South Africa. And that happened at the same time as our downgrade. And so if we look at the yields that South Africa offers, particularly in the bond market, the 10-year government bonds are yielding anywhere between 7 and 9%, depending on the time. And if we compare ourselves to other emerging markets, that yield relative to our rating grade is the most favorable. So as developed worlds start to get into the structurally low growth environment and they develop more of a risk on appetite and a search for yield, we are likely to see the potential for flows. And it's really important that we as a country put our best foot forward. Some of the investors have said they feel that Russia is opaque. It's very difficult for them to put money into Russia right now, particularly in the light of the timing with the US elections. They feel Brazil is highly volatile, and of course the COVID crisis has gripped that economy quite significantly. And they don't really put us in the same category as Southeast Asia. And so there is a sentiment that I'm hearing from a number of offshore investors that South Africa is looking increasingly favorable. And we're always our own worst enemy, and we get to catastrophe thinking very quickly. But in fact, South Africa has a lot to offer in yield and we need to just focus our infrastructure investments and our job creation stimulus in the right industries in order to give confidence to overseas investors.
Now, since he became the president of South Africa, Cyril Ramaphosa did his utmost actually to get the economy growing, to attract investments and so on, and to really make life better for all South Africans. But of course, things have changed dramatically. The president organized 2 investment conferences, and the idea was actually to attract something like R1 trillion to South Africa. Do you think it's still possible to attain that, given what's happened subsequently?
I do think that there is an appetite to invest into infrastructure globally, and I do believe that there is an appetite focused on Africa and Southern Africa. And so the possibility exists. I think the most difficult thing, there is not so much a lack of funding as there is a concern around our ability to execute and deliver, get spades in the ground, make sure that those infrastructure projects that we are planning actually get executed and get implemented according to budget and timeline. And so in order for us to create confidence, we do need to ensure that those projects are show progress. Now, the JSE is looking into a potential private placement platform, which would enable infrastructure investors to access funding and access liquidity without having to comply with the very much more onerous listing standards, sort of listings requirements that we have on our main board. And we think that there is a genuine likelihood for us to enable that. In addition to that, there's also a high interest in green bonds and sustainability bonds. So we have been speaking to a number of government officials to explain the benefits of raising debt in the form of green bonds or sustainability bonds for socially responsible investments. And investors certainly are seeing that sustainable investment does produce more resilient and more sustainable returns. It's not just a moral imperative. There is also an economic logic to it. And the largest asset manager in the world, BlackRock, have publicly declared that sustainable investing yields much more favorable returns than the other non-sustainable companies, because many times you can have oil spills or major fines, and those companies are more susceptible to shocks and to dislocation in their earnings. And so there are a lot of great opportunities, and we are introducing some innovative tools to enable capital formation and attract investment.
Then coming to South Africa and investors here, from various reports, I get different figures, you know, let's say in general, there's something like R1 trillion that's just sitting there in cash in the vaults of companies, and they're not using that, they're sitting on the fence. And foreigners can ask, quite rightly then, if you guys are so reticent to invest in your own economy, why should we?
So, Fourie, this is an interesting dilemma, and I do think that at the moment this is a global phenomenon. As soon as there is uncertainty, and we have policy uncertainty plus the uncertainty relating to the pandemic, large companies withhold their capital investment, and that is a general trend. That said, when I was in America last year, I had a chat to some of the investors, and they were indicating a very strong interest in Eskom, and they made a comparison to the Genoa Bridge collapse in Italy. And they said that when the Genoa Bridge collapsed, Italians had no faith in the system. None of them had the risk appetite to invest in the new infrastructure. And corporate America were the ones that climbed in and invested and funded the new infrastructure, and they've made an enormous return on that investment. And so there are foreign investors who are aware of that, but they see it as a potential opportunity because they can see the potential for returns on, for example, our power, our ESCOM plan, dividing into, the company into three different sections or divisions or entities. And so I do think that there are multinationals who see potential for return, and they do have the risk appetite to weather the potential policy uncertainty and the potential fiscal overhang that the government is staring into at the moment.
Let me just quickly slip in this question about COVID. I read a report this morning of people saying that it was a fundamental mistake that we extended the lockdown after the first initial 3 weeks, and that we're killing the economy and that we can hardly ever recover from this. What is your comment on that?
Look, I think it's a very easy thing to sit as an armchair specialist without the epidemiological insights. I think in the beginning, the government acted swiftly. There are reports around the 90% economy, which indicates that notwithstanding there was a huge impact on the economy during the protracted long lockdown, that those aspects of the economy which are struggling to recover are limited to 10%, and 90% of the economy is going to recover. I think that what is most critical right now, it's less about whether that lockdown should have been extended or not, because that's in the past, and more about, are we going to ensure that our fiscal stimulus is properly administered, and are we going to ensure that SMEs, that money that was initially designed to fall into the hands of the SMEs, that it in fact finds its way into the right productive spaces. So I think fiscal allocation and administration of the fiscus is going to be absolutely vital to create a bounce back in particularly the SME sector, which has been so badly hit by the lockdowns.
And the problem is corruption is a major problem in terms of handling COVID-19. And you certainly must also keep an eye on that kind of thing, thinking that how can we assist in actually punishing those who are corrupt or who are actually acting in a way that is not conducive towards growth and confidence in this economy.
And corruption in the face of a crisis that is affecting the livelihoods of individuals, both commercially and in their health, is a deeply troubling problem that we're facing into. That said, JP Landman wrote a really good article about all the many things that Cyril Ramaphosa has done to try and introduce controls and checks and balances. At the exchange, what we control is obviously the corruption that could, well, we don't control it, but we oversee the listings requirements. And you would have seen that we have levied a number of fines for companies that have breached their listings requirements. We continue to focus very heavily on that. And that is an important symbolic message around corruption. And I think what is really important at a government level is a balance of consequence and a swift response, because the moment that message gets out that that when corruption happens, there is a balance of consequence, I think the likelihood of repeat behavior diminishes. So we also are looking into how we can better collaborate across the regulatory divisions, so between the NPA and all the other regulators with whom we interact, to ensure that if there is a fraud on a listed entity, that we're able to openly share that information and vice versa, because there is a very close line between criminal and civil cases. And the sharing of information and the enabling of more swift response is really vital to send that very powerful and important message.
You referred a little bit earlier to 342 companies that are listed on the JSE at the moment. But that, of course, is a number far less than it was a couple of years ago. So why do companies, local companies, decide now to delist?
So listings is a global, the listings contraction is a global phenomenon. And this is something that we are acutely aware of. And it's not a new problem that we're facing into. This is a cyclical problem. When the economy turns down, companies don't tend to raise capital and they don't tend to list. They tend to hold back until the economy starts to grow and expand. Coupled with that, we've also had billions of cheap dollars pumped into the money by central banks from 2008, which has found its way into private capital funding, so private equity, for example. And that has also affected the number of listings on the public market. Most of the delistings that you would see, if you look at the numbers, it looks like it's an extraordinary number. But if you look at the market cap, our market cap is actually growing quite tremendously over the last 5 to 10 years. And so many of the less liquid stocks are affected. Unfortunately, in South Africa, because we have a very high institutional environment, the institutions tend to invest quite heavily into the top 40. And that leaves the rest of the counters less liquid. And we do need to try and stimulate more of a retail investor base in the country, because that does tend to diversify the levels of investment across the entire value chain. But we do have a classical cycle where those less liquid companies are genuinely exacerbated through the crisis, and their ability to both generate cash and to therefore attract capital is very limited.
Well, you've referred to that now, but what specific measures do you take actually to help those companies to actually be more liquid? And do you actually talk to them and say, no, guys, you know, let's do this thing and keep investing or keep the listing?
So we obviously wouldn't interfere with free market forces as the regulator, and ultimately companies' capital and cash positions really are managed by their boards. What we can do is create an enabling environment. And so, for example, during the COVID crisis, we reduced the trading and settlement fees on our AltX and our mid-cap stocks by 50%. And the objective there was to try and stimulate trading. Now, that will help, but it's not going to fix the underlying problem. The underlying problem is twofold. Firstly, we don't have a big enough pipeline of companies. And secondly, the risk appetite and the investor appetite to invest in those companies is not as mature as it is in, say, for example, Canada or Australia. So there are aspects that we are looking at. It could involve tax considerations, policy reform that we may choose to lobby and engage policymakers on. In addition to that, we are also looking at potentially creating a private placement market, which would be focused on the SME area, which would enable investors to come together on a common platform and for SMEs to attract capital formation without having to comply with the very formal listings requirements. So it would be more of a buyer beware type market, and thereby enabling a bit more liquidity in a slightly less onerous governance environment. So we are very excited about that, and we would look to introduce a solution like an infrastructure or a platform like that on very modern and forward-thinking technology potentially. Those are the main things that we're focused on in that area, is enabling infrastructure.
I don't want to be part of that negative narrative that you referred to when you arrived here in South Africa coming from Australia in November last year. But at the same time, after this pandemic started to grip the country, we really have a situation where smaller companies in particular, those that you are targeting now and that you want to be more part of the economy, those are the guys who are suffering and who probably are going under, and it's going to be a slaughter.
Indeed, there are, in fact, even in the larger companies, 19 companies between March and April reversed their dividend declarations. And so there are companies who are under cash flow pressure, and the stats are concerning around those small and medium enterprises' ability to weather the storm. That said, there is also significant stimulus that is being pumped into the economy through the recent IMF loan. And in addition, I have sensed a sentimental change, which is quite genuinely likely to yield results. And that is that large corporates appear to be much more serious about building the economy from the bottom up, about supporting the local smaller entities. In addition to that, having traveled overseas and spent time living in another country, it always intrigued me that South Africa never had the same sort of local is lacquer, buy South African mentality. We always thought that buying imported goods was best. And I've seen a genuine sentiment change and confidence change in the broader consumer base. And so it's hopeful that those two aspects can move the dial and can support these companies. But there's no question SMEs are in trouble, and particularly in certain sectors, the hospitality environment, the tourist environment, and that has a broader compounding effect on the economy. So we shouldn't underestimate or undermine the very difficult position that those organizations are in.
When do you expect some kind of normality to be established, for instance, blue chip companies declaring their dividends?
Look, I can't predict, and it's very difficult to say when this would happen. What I can say is the factors that would influence companies' recovery rates are really a combination of both macro global environments and local environments. So I think the ability for government to ensure that fiscal stimulus is properly administered and gets to the right hands will have an effect. The ability for government to create policy certainty, and particularly around SOEs, etc., has a compounding effect on consumer confidence, on business confidence, and that drives flows. I think it's also very sector specific. So you can see an immediate advantage that both the resource companies and the tech or data companies are enjoying. The banks are down, the large banks are down more than 40% in market cap year to date. And the hope would be that those banks are having lifted their, buffered their balance sheets for potential bad debts, that they're able to bounce back. But the real question is, are we going to get COVID under control? Are we going to have a second wave? If there is a vaccine, will we have access to it urgently? And also, how is the rest of the world going to recover, and how quickly will the pent-up demand for yield in the developed world countries, which are in a structurally low growth crisis too, will they in turn start to respond, and will we see flows back into the country? We've had enormous outflows in both equity and debt markets over the last 18 months. So those factors together, I think, are really important. And again, also, government's ability to repay its debt relating to this very serious fiscal overhang that we're facing into will affect confidence.
Well, that's exactly what I wanted to ask you next, and that is the debt levels in this country that are so severe. And Moody's, one of the agencies that actually downgraded us so heavily, they specifically said South Africa is in a worse position than some other emerging markets, and that we simply do not have the capacity at the moment to repay our debt, and they have serious concerns about this. So it seems that we're in for a difficult time.
Look, there's no question that our debt to GDP ratios are extremely high. That said, the Treasury has been very expeditious and well managed, in the sense that the maturity rates, the rates at which those bonds mature, has been very strategically and well thought out in terms of the flow of funds. In addition to that, if we compare ourselves to other emerging markets, our our dollar-based or hard currency-based debt is very low, less than 10%, and most other emerging countries are north of 20 or 25%. And so we don't have that doubling effect of currency crisis and our debt inflating. In addition to that, I think the IMF loan and the repayment profile, which gives us a 2-year gap, is helpful, and the fact that we are only going to be charged 1% as opposed to the current sort of just around 8% that we're paying on our debt burden. The problem I think that we're facing into in this debt to GDP cycle is that our GDP is contracting, and our outlook on growth is potentially lower than many of our emerging market peers. And so that ratio will be widening and getting worse, and that's a key ratio for both the cost of our debt service fees, so our interest costs, interest bill will deteriorate as that ratio deteriorates. And so we've got a denominator and a numerator problem in this measurement. So yes, there's no question we are facing into a very, very difficult period. But again, South Africa is entrepreneurial, and we have a way of getting to the abyss and pulling back and managing through multiple crises, and history has taught us that.
Well, as you know, many pensioners are very worried, and so are some of fund managers who say there's a pile of cash that the government is eyeing, and there's a danger that they can decide in a crisis like this one, so let's go and delve into that pot and take the money out to the detriment of the pensioners. Do you think this is likely to happen, or what is your view about this?
Look, I haven't seen explicit signals in the recent past about prescribed assets or the pot of pension fund money being allocated. There are many ways to try and encourage investment into what they would call prescribed assets. I don't think it would be a good thing for international confidence in our market, and certainly not a good thing for the general returns necessarily. But we really wait and see what the government's ultimate position is on this.
Well, just quickly, what are the other negatives that you see in the country that must be dealt with? You already referred to growth and then also to the debt levels. Unemployment is another one, and so forth. Are there particular sectors that you are worried about, or developments that you are worried about?
So insofar as sectors go, I think tourism and the hospitality industry have a compounding effect on the overall economic growth, because to the extent that we have visitors coming into the country, they don't just spend at restaurants and at hotels. They go and buy clothing and diamonds and gold and jewelry, etc. So those industries really do need to be supported. I think in order to address the concerns of overseas investors, we need to see real action and implementation. Consensus building and any delay to implementing government's growth initiatives will have a damaging effect on the economy. I think the SOE situation is a genuine worry and a concern by international investors. Obviously, Eskom and its exacerbating effect on the economy is really crucial to address. So whether there would be a green or a private sector involvement in certain aspects of that value chain is yet to be seen in actual action, but swift addressing of our energy crisis is a major concern. There are obviously major views and very strongly held views around whether SAA should be bailed out or not. Ultimately, I think that directing the fiscus towards job-creating initiatives is really crucial. And also addressing corruption I don't think we should underestimate the impact on potential foreign investors' inbound flows, and also foreign investors' willingness to set up shop in South Africa. So policy certainty, driving funds and policy activities towards job-creating industries and addressing corruption, I would say, are pretty important areas of focus to address the underlying weaknesses and vulnerabilities in the economy.
What gives you hope?
What gives me hope is that I do think that Cyril Ramaphosa was swift, and his leadership created the impression and certainly the perception, which I think was a true perception, that he was able to drive action in government. And I'm hopeful that potentially out of this crisis will come both policy and macroeconomic reform that would drive job creation and drive implementation and a call to action. And I'm also hopeful that private and public sector will integrate and work together to rebuild the economy, because the past, I think that in the past there's been opportunity to genuinely improve that public-private sector collaboration. And I'm certainly seeing green shoots, and I'm seeing a lot more collaboration than what we've seen in the past. So those are probably the two areas that give me the most hope.
Let's just quickly talk about reform of the JSE. You know, of course, that 10, 15 years ago, and even in some verses, there were people walking on the floor and shouting and screaming and so on. Now we've moved a little bit towards the new digital age. But 10 years from now, what would we be seeing then?
Yeah, I was actually, Fourie, at an interview a couple of days ago, and I was just saying, can you imagine if we had an open outcry environment now, how those charismatic traders would have coped under lockdown? And so, yes, we have swiftly moved to a more digital environment, and tech is very much in our DNA. We've invested heavily in technology, and that has seen us and made us through the crisis and made us resilient against the dynamics of the crisis. Into the future, I think there are likely to be digitized assets, and it may be a digitized form of a wheat contract or of various different underlyings. I think that blockchain and more forward-looking technology is likely to be used. And because of that, I think that the private market, public sector is potentially likely to blur. So you may find exchanges like the JSE offering more of a private market environment, which appeals more to the sort of private equity venture capital environment. So I do think that we are facing into tremendously exciting transformation. And I think that rather ironically, the COVID crisis has expanded and increased the rate of change and the rate of adoption of new generation technologies.
And then around you have a very strong team of women. Is that deliberate, your strategy?
I think what's deliberate, Fourie, is that we like to have competent people around. and it just so happens that they were female. We are certainly, sustainable development is at our core, and social equality is one of the cornerstones of sustainable development. And so 80% of our board is female. Both the CEO and the CFO are female, and the chairman. And a large part of my exco are female. Now, I always personally like to have a very balanced and diverse group of people around the table. And we've probably got more females than males at the moment. So we do need to rebalance that. But I do think that the exchange is a symbolic face of capitalism, and therefore the standards of probity and the standards of governance are very high at the JSE. And so it's important that we abide by our rhetoric and what we put out into the market. And our general priority is that sustainable companies, sustainable investment, which includes gender diversity, gender pay parity, is really important. People tend to hire in their likeness, so it's important that you have an equally balanced senior management team in order to attract diverse thinkers.
Leila, Fourie, thank you very much. It's a pleasure talking to you. Good luck.
Thank you, Fourie. Thank you. It was lovely to chat.